Let's get into it. So first, why do people trade earnings? This is something that, we see every quarter. There's people wanting to trade earnings. And so what is earnings? It's just companies sharing their financial results, beating or missing expectations. That's really what the information that a lot of people are trading on. And they also announce the companies. They'll talk about new product initiatives, forward-looking forecasts, and stuff like that. And then another big thing that I want to mention about earnings is the earnings cycles. So you could take a picture of these slides here as well. And so just to go over the earnings cycles that we typically see when most companies have earnings, usually it starts with banks, right? Something like that.
Yeah.
And then it goes on throughout the rest of the market. And then so that's really like April to May, July to August, October to November, which we're in right now, and then January to February. So this typically happens after the fiscal quarters end, and then they report their earnings. And then, so Luke, what are some of the reasons people like to trade earnings?
So earnings are great for a few reasons, right? So the increased volatility is always good for any options premium sellers, because volatility is going to mean that you can sell any options for higher, right? And so that's a good opportunity if you'd like to sell something short or do a short spread. This is going to give you more money on the get-go, and then when the volatility crushes later, you're able to make a profit off of that. And then also, there's just a lot going on. The markets are moving quickly. There's lots of excitement. There's lots of interest. So this is just a good time for opportunities in any direction, whether you think it's going to go up or down. And this sort of brings us to the next point with earnings, where, like we have in here, it's a binary event. So what that means is it's like, well, I mean, I guess technically speaking,
really like it moves one way or the other.
it moves one way or the other,
binary
right?
event, or like volatility stays bid or it doesn't.
Exactly. So it's like if it's going to go up and you make the play, you can usually bet on the direction of it's going to go up, it's going to go down, and you're either going to buy something and lose the little bit that you put into it, or maybe make really big if you bought a call and it skyrockets above what your call price is.
Yeah, and so what we like to say, about earnings, there's not a lot of management time, but it's typically like instant gratification and then instant pain as well. So that's something to keep in mind when trading earnings. There's the increased volatility because people are expecting a lot of moves. There's fast moving markets, and then the binary event, just because it typically will either go up or go down, or the volatility will either crush or expand a lot. And then, so earning strategies. Typically, there's two ways we see customers go about the earning strategies. It's either you're betting on direction or capturing premium from volatility.
Exactly. And that's really the two basic ideas. You really can do any mix of this as you want to make money off of an earnings play. But ultimately, that boils it down to the two most basic ideas. You're either selling premium or you're betting on direction and hoping to win big.
Yeah. Exactly. So let's go over some of the strategies that we have here. So first, we'll go over the directional strategies, the bullish and bearish strategies. So that's like single leg long options, like buying a call or buying a put. And then we've also got the single leg short options, like selling a call or selling a put. Those can also come with greater risks because the risk is not defined. The losses can be unlimited, And then so we've also got debit spreads, like buying an out of the money call spread or buying an out of the money put spread. And then we've also got credit spreads, which is just the opposite of that, selling those option spreads. And so that's a lot of what we see the customers do with options when trading earnings directionally. It's either like you buy the options or you sell the options, playing it to go up or to go down. And then, Luke, you want to go over some volatility strategies as well.
So that's sort of the binary event that we're talking about. And then these are the volatility strategies. So you can do a short straddle, which is where, you're going to sell a put and a call right at the same strike, or you can do a strangle where you sell them at different strikes. You can do a short iron condor, which is kind of like a defined risk strangle, an iron fly, which is like a defined risk straddle. Or a butterfly, which is more of a neutral strategy, but it's also defined risk. But really, these are all about just taking a very high credit on the onset. And then hopefully, if the earnings are nothing, right, the stock will eventually basically stay the same or maybe have slight movement, but the volatility is going to have gone away because people know, oh, look, there's nothing going on anymore, right? We know what this company is going to do for the next quarter. Unless there's a big announcement, the volatility is not going to come back. So
yeah, exactly. And so when it comes to like these neutral strategies, because the bullish and bearish strategies, they're pretty straightforward typically. But when it comes to these neutral strategies, if you're selling the straddle, you're really making a big play on volatility, and there's a lot of price risk. So you're going to get a massive credit, but you're getting that massive credit because you're taking on a large price risk. And then when it comes to the short strangle, you're taking the straddle and then moving it out. So you've got a higher percentage profit, but you're also getting a lower credit because of that. So you've got more wiggle room for your strategy, but you may see a lower profit than the short straddle if it were to stay, right at those short strikes, right in the middle. And then iron condor, all you're doing is buying the wings of the strangle. To keep it defined risk, it'll use a lot less buying power, a lot more capital efficient, but not as flexible as a strangle is. And then you've got an iron fly. So that's basically the straddle with buying the wings. And then that will just keep it defined risk. And then we're talking about butterflies. If you think it's going to, pin a certain strike out of the money on either the downside or the upside, that's where you can place a butterfly trade to say, hey, I'm willing to pay a small debit for these strategies, but it could be a big payoff if I'm correct. And then something we also want to touch on is if you think volatility will expand, you can do the reverse of these trades. So you can buy the straddle or you can buy the strangle. If you think it's going to move outside of the expected move, if you think that's going to happen, then you can do the reverse of these strategies because volatility is high. So typically we see a lot of people wanting to sell premium, but the volatility is high for a reason because they're going to make an announcement. And so if there's something unexpected, it could go outside that expected move. So that's why I want to mention if you want, you can reverse these trades. And then, of course, this isn't an exhaustive list. Excuse me, this isn't an exhaustive list that we have. There's a lot of other strategies that you can use, but this is typically what we see a lot of customers do.
Yeah, these are the most common ones. One of the beautiful things about options is that you can get creative with these strategies. They can be a little bit more difficult to manage if they're outside of, the normal wheelhouse of what an option strategy is. But beyond that, you can be creative with these, right? You can combine directional strategies with neutral strategies to, get a credit to help offset a directional play or vice versa. So you have a lot of flexibility with these. These are just sort of the most common, the most well known for earnings plays in general.
Yeah, right. And like there's no wrong strategy that you can use. And that's the beauty of options is that they're so flexible to get what you want out of the trade. And so this is an exhaustive list, but this is just something that we want to give you guys to start off for trading earnings. And then so when it comes to companies with earnings, how do we find them? So we'll hop into the platform in a bit, but this is one of the ways that you can see them. This is through the watch list on the tastytrade website. And so we have a specific watch list for just earnings. And then there's a column you can add as well called earnings at date. And then we'll show you where those earnings are, whether it's before the bell or after the bell. And that's something super useful that we have on the tastytrade platform is showing you a preset watch list of all the companies in the stock market that have earnings soon. And so that's what we'll be looking at as well. And then another way to see it is through the trade page and the overview on the right-hand side. So when we're looking at the trade page, you see that purple line that shows October 22nd for Tesla. And that shows that if you're looking for the different expirations where you want to choose your trades, that purple line will show you where to go. This screenshot was taken on October 16th. So you wouldn't want to go in the October 17th expiration if the earnings are on October 22nd. So you'd want to make sure to go after that purple line. And then also on the bottom right-hand side of the screen, we've got the overview tab as well, which will show you the earnings and then on October 22nd after the close. So this will just be in the overview and the Tesla quote details. So these are super useful ways to use the platform to see where the earnings are, when a company has earnings. If you have a position on, for example, and you already have a trade on, once the earnings get announced, where do you want to go from there and how do you manage the position? So that's something we see a lot as well.
Yeah, and I think also the beautiful thing about our platform, right, is we show you the implied volatility per expiration date. So you can get a visual of what the volatility actually looks like for the upcoming earnings compared to the normal expirations. So, I mean, with all of that information, you should be able to at least have a very clear idea of what type of play you should make, depending if the volatility is high or low, basically.
Yeah, exactly. And so this will show you just where the earnings are, how to see what companies have earnings if you're looking for trade inspiration. And then also if you already have a position on where you can see the earnings are and then how to manage from that. If you want to turn your current position into an earnings play, or if you want to move further out or just close the position so you're not as heavily affected or not affected at all by the earnings. And then so from here, that we'll do. First, we end up flow and Condor. Earnings fell today. And then we've got TXN Strangle. That's more of a not defined risk play, undefined risk. So it's a little bit more flexible, taking in a higher credit. And then we've got Capital One, just a short put spread showing you how to put on a directional trade. And then we've also got a Tesla long call spread. Their earnings aren't until tomorrow, but we just wanted to show how to place, more than just a few trades. So that's what we'll be getting into now. And then let me go ahead and pull up the platform.
The exciting part.
And so here we've got the trade tab on the left-hand side. So for example, let's start with pulling up Netflix. So at the top where it says find a similar company, you'll just click on there. And then also just to show what platform we're using, we also have a downloadable desktop version. But for today, we're going to be using the tastytrade website. I love the web platform. It's getting a lot better and a lot more comparable to the downloadable desktop. And then we're going to also have a downloadable version of this as well that we're going to be transitioning to. So the website's great. I would say get familiar with it. I was desktop, ride or die until I was able to download this version in the beta. And so we're coming out with that soon. And then so today we'll be using this on my.tastytrade.com. And you can sign in there to follow along. You can also follow along using the desktop as well. Very similar platforms. And so what I've got here is first at the top where it says find a similar company. That's where we can search for our first ticker, Netflix.
Oh, Netflix.
Yep.
I remember ordering the DVDs in the mail. So
And then so from here, if we're looking for an earnings play, Luke, I'm thinking just October 24th, just the next one available.
yeah, the IV's
The
looking
next
high there.
expiration. Yeah, I mean that's where you're gonna see the biggest, price movement, whether that's up or down, the biggest price movement due to the earnings, as compared to what those options are trading for now, right?
Yeah, actually, I'm curious, what does the next expiration date look like? Just a little,
Yeah, so I mean, you
yeah,
see the
90
difference
to
between the
60.
implied volatilities in both expirations.
Yeah.
So, I mean, it's almost 100 here in the first expiration. And then as it goes down, the back months are all the way at like 30, ish percent. But then we go from almost 100 to 60%. So, if you want the biggest volatility crush, this is where it would be in the 3-day expiration. But that's also, of course, where you're taking the most risk as well. But you'll get paid to take that risk because the volatility is so high. And then, so Luke, when we're looking at the put side to the downside, what are you thinking our strikes should be?
I think we should play this super safe, and I'm thinking right outside of that expected price range of movement.
Speaking of expected move, I can't believe I forgot
Yeah.
to mention that, but this brown bar that we have on here, this will show you the expected move, and you can have this for any stock that we're looking at when you want to see the expected move on the option chain. So we have it here in the top right as well, where it shows the implied volatility, and then it calculates the expected move for you. And then this brown line also shows it where it is on the strikes. And so here are you thinking the 1150, 1145? Is that what you're thinking for the put side?
Yeah, right outside of it, just
Okay.
just touching it.
Perfect. And so when we're looking at this, we're just doing a 5 wide spread. You can obviously move it out. You can click and drag to move it out. That's something that's beautiful about the platform as well. And then if you ever want to change the quantity, you can use these buttons here, or you can type here in the bottom left in the order details. I will, however, not be swinging 5 lots, just to make sure, we
Yeah.
keep our jobs here. We like doing the demos. We're having fun, I'm going on the Tasty Live Network. We're having fun out here.
I think it's
So-
real money in there, isn't it? Yeah, it's
it's really real money.
Yeah,
I
it's
mean, this is a
definitely
real
money.
account, so we're just going to do a 1 lot for example purposes. And then when it's going to the top, the upside, if we're looking at the calls, what are you thinking here?
I would say same thing. Let's do like the biggest winged condor you could ever see.
Yeah. So we're going a little bit further out of the expected move. What are you thinking? 13. Well, we could just do 100 wide here.
Yeah, I think
Almost.
100 wide. I mean,
I mean,
that's
we could do 1350 and 1150 or 100 to each side.
yeah.
So that's 200-point range. That's a pretty big range. I mean, Netflix could, of course, exceed that. But I mean, that's a pretty big range for a $1.70 credit as well. That's a pretty nice sizable credit for how far we're getting at. You've got a 200-point range.
Yeah, and
on this
our
here.
buying power effect's actually not that bad either. 331 for one spread is not bad. Yeah, no, that's a decent trade. 171 to 329, not bad. I like
Yeah.
keeping, max profit at least a third of your max loss. It's a nice
Yeah.
nice place to be.
For sure, yeah. I mean, one third the width of the strikes, and then so we'll try and send it at 170, see if we get filled. If you ever want to change the price, though, it would just be in this limit price box. And then from here, we can click review and send. And then, of course, review any commissions and fees. We're super transparent about that sort of stuff. And then we can submit the order. And then so it looks like we got filled a little bit above
Nice.
at 173. And then so here we can go to the positions page. And then here we've got our Netflix Iron Condor. And then so also, if you want to take a picture of this as well, these are typically the columns that I recommend for most options traders is the trade price and the mark, what you got in the trade for 173, and then what you could get out of the trade for is where it's marking. Right now it's 177. And then we've got the cost and net lick, just the actual dollar values of those amounts. So if you're doing multiple contracts and you want to see what the actual value is of that position, those columns will show you. Day close price, you can sort of ignore. This is something that I use on the trade desk when people have questions about P&L day. The difference between the day close price and then what it's trading for now is where your P&L day will be. And then we've got, of course, just the P&L day and P&L open. And then anything beyond that you can use. Feel free to take a picture of this, though. These are the columns that I like to use the most. And then we could also go to page 2 as well. And then it'll just show like the amount of days since the open, just the net vega as well for any naked positions, and then your underlying indicators I like having as well. So you see this purple E0
E0.
because we got earnings today.
Earnings is today.
That's what it's for. And so yeah, that's what we got here for Netflix, our Iron Condor, and then we go back to the trade page just to show where it is. And then this is our trade right here. Looks like there's maybe a drop in Netflix as we were placing that. Probably why the credit went up. Right?
Yeah, I think it's exactly why the credit. We caught it at a good time.
Yeah. Yeah, and then so what we're going to see here as well with these blue lines, I want to mention this. If you ever want to make a play for the one standard deviation, maybe this is something we could do in TXN, one standard deviation strangle. But we've got the one standard deviation line here. And then for two standard deviations, we'll have those lines as well. And then so let's try and go to TXN and see what strangles we could put on here. So are you thinking the 3-day, or maybe do you want to be a little bit more conservative, go further out in expiration?
Let's see. Well, we're doing a strangle, so we really do want that volatility. So I guess really the 24th is probably still the best for us. Little short-term strangle. Because we're about 85% there for volatility.
Yeah, I mean, the vol is going to be elevated so much. And typically when we see customers trading earnings, sometimes we'll see customers go to like the monthly expiration for, November 21st, if there isn't a lot of liquidity. In these ticker symbols that we've got here, there should be, a good amount of liquidity, but you could always go to the monthly expirations, but those won't be as sensitive to the price movement as they will be in, just the next weekly expiration that you have. And so for a one standard deviation strangle, we could go to the 165 on the put side. And then from here, we could go to the 197.5 on the call side. And then so we've got about $1.66 credit. I mean, the markets are pretty tight here, about 10 cents wide on the call side. And so I'd say that's well within the liquidity range. I try and always say like 10% of the bid and ask spread. If it's any more than that, you sort of might, want to watch out, stay away. But with 10 cents, especially when it's, only $1, it could be, more liquid than you actually think. And so there's only, so many increments you can have, right? So we could try and send it here. I want to just show how we can replace an order as you're trying to get filled. So I'll send it a little bit above the market, just at the ask. And so that's something super cool about this price bar here. You can click on this to move the price around. So if I just click on the ask, that'll send it above the market. And then we can walk it down from there, just see what it's like to really try and get an order filled. So here we'll press review and send, and then submit the order. And then so that's working. And then the way I like to replace trades on the trade page is just go here where there's this yellow icon. On the downloadable desktop, it'll be similar. There will be a yellow W. And then you can just right click on this, and then that will pop up your menu where it says cancel, replace similar or opposite. And then from here, you can click replace, and then that just pulls up another order ticket to replace the previous one that we just sent. So here I can go and click on the mid on the bottom there, and then hit review and send, and then submit. And then the mid is typically where I'll start for sending spread orders, multi-leg option orders. I'll always start at the mid and then work it from there, just like we're doing
Exactly.
here. I mean, there's a real life example of trying to get filled on a trade,
Yeah.
you know?
And sometimes it can be a little difficult. I think on these strangles to get filled, strangles and butterflies. Um, but yeah, if you're offering a credit, just offer the market makers less, or so they'll pay you less.
Yeah.
They'll always take the trade if they could pay you less.
Yeah, and I mean,
Unfortunately.
something I always think about, I've heard this from the Tasty Live guys, do you want the penny or do you want the position? So right here, I see the mid is 166, at least for the demo, we want the position, right, to just get it open. And so we'll try and go to 164 here, see if this gets filled.
Man, they still haven't filled us yet. Wow.
And then there you go.
There we go.
Filled at 164.
Yeah.
Very simple. And then so we can now go ahead and see this on the positions page as well. And then so we've got our TXN strangle. And then this is what we're looking at here. And then let's go to the next trade. We've got a Capital One short put spread. So we'll search this up in the find a similar company up top. And then also, if you're used to using the desktop and you're using the website for the first time, you can also click here as well. And that will just automatically pull it up to search a symbol. And then so from here, we'll go to the trade page. And then for earnings, we'll just do the October 24th again.
Yeah,
Because
right.
if we want the earnings play, we want the volatility, we want the direction right away to get, the most amount of profit potential, but also the most risk is just going straight to that weekly expiration.
This is another short trade, is it? Is it a long trade?
Yeah, so this is a short put spread.
Yeah.
So it's another short trade, but it is directional. So it's not neutral anymore. So this will be a directional play to the upside. And then how aggressive are you feeling on a Capital One's earnings here?
I'd like to think I know more about Capital One than I do, but I know very little. But given inflation and everything, I would say let's be aggressive on this one. Let's be aggressive on this one.
Okay. And that's something I love to think about as well is, because like the thought process that he just went through, like talking about interest rates, maybe they're collecting a lot more on their interest, but everyone else is already expecting that as well. So it's like they might have expectations that are so high already that it could go down, or you're thinking maybe the expectations are understated for where they could be. And that's why we see a lot of options traders want to play, the information that they see out there, just what is the market telling me right now? Where's the volatility? And, saying that, hey, for earnings, volatility might be overstated, and then selling that volatility. Or you think, Capital One hasn't been going up enough for where it should be.
Yeah.
And so maybe we're going to take a little bit of a aggressive approach to it, but still have a higher than 50% chance of profit. So we could go to something like the 212.5, 207.5.
Yeah, be more aggressive because it's like I think I read something about there's like a lot more credit card debt than there used to be. People are defaulting more, which is honestly terrible for the average consumer. But as a trader, you got to think about those things too. There's always an opportunity, unfortunately, whether the opportunity is for good or bad reasons, right? So that's just what I was thinking about. So let's be aggressive with it. I'm sure credit card companies are doing great right now.
Yeah, and so we could try this here. We'll try it at the mid price of 165. Make sure to hit that lock button before submitting the trade, and then we can up the price. So it was just 165. The markets are moving around right now. I'd like to see a little bit more liquidity in Capital One. I mean, we'll fire off the trade regardless, but I would like to see a little bit more liquidity
there's
here.
not a ton of
when
open
looking at
interest
these spreads.
considering.
Yeah. But so here we can go and send this trade. And then that'll stay working for us at 165. And then we'll go ahead and replace it. We'll move by 5 cents at a time just to see if we can get filled. And then that's working at 160. And then we'll try 165 or 155. I think we'll get filled there.
We should, at least, I imagine.
Yeah, filled at 155. And then we can go back to the positions tab. And then there we go. We've got our Capital One trade as well. And so we can look at all these different positions next to each other. And then the last one, we've got Tesla. Their earnings are not until tomorrow. But I mean, sometimes I can't stay away.
Yeah, no.
Right? Sometimes I can't stay away.
I mean, Tesla has been the darling for as long. I mean, Tesla's been a darling, I think, longer than I've been an adult.
Yeah, I mean, look at this chart here. Let me zoom out a little bit. I mean, look at this run up that we've seen really starting since, the beginning of September. I mean, that is just green bar after green bar.
Man,
right there.
Every time that someone says that Tesla is out for the count, I'm not a
Yeah.
quitter every
I mean,
single
well,
time.
you know, it would have been really hard to say on, March 11th, thinking that it's going to go up after freaking 20 consecutive days, 20 down days,
But they lost,
in a
yeah,
row,
well, almost 100, 200
whatever
bucks,
that may be.
$200 they lost.
Yeah, what? So we're going from like 360 to
Oh man,
220. I mean, that's pretty far though.
yeah,
That's a big drop in one swift swoop
man.
right there. But then now, I mean, look at this.
6 months
It was
later,
choppy for a bit. The premium sellers were probably doing really well there. And then, I mean, the market, just like the rest of the market as well, Tesla just went, parabolic.
yeah.
And so,
I
yeah,
mean,
that's
I
what we're
wonder how
seeing
like
here.
Bill Gates and Warren Buffett are doing with their short positions on Tesla. I heard about that like 5 years ago. I think
They
Bill
they
Gates,
trade short positions. Like,
yeah,
I didn't even know they did
I
that.
think, I mean, don't quote me if I'm wrong, but I'm pretty sure Bill Gates was saying he's had like a, excuse me, he's had like a short position on Tesla for like 5 or 6 years or something crazy like that.
I didn't know he really traded like
I
that,
don't know. Yeah.
you know?
I mean, I mean, I'm always shocked how Tesla just is, it keeps going. It doesn't
Yeah.
matter what happens.
Well, if we think this pattern will continue, we can buy that out of the money call spread
That's
and
right.
see where we're going to go from here.
Yeah, exactly.
And so let's hop into that October 24th expiration. I mean, you see actually compared to, Netflix, it drops straight from, 100% to 60%. Here
Mhm.
we're going from 100% to like 75%,
Yeah, this
which
one,
is actually less of a
huh,
decrease. So that's definitely like the volatility smile. That's something to keep in mind because look at how much
interesting.
more elevated the back months are.
Yeah, it's
It's
like
at
at
60
60.
plus percent. And then with Netflix, we can go back to that. This is actually interesting to see in real time with Netflix, it goes all the way down to 30%. So you can see here, there's a lot higher implied volatility. So Netflix, you could see as potentially the more premium selling trade. But obviously, that volatility is there for a reason, right? But if it were to normalize like the rest of the expirations,
Yeah,
it could drop by 60%. But then when looking at Tesla, this could be seen as a more directional play because the volatility is staying bid throughout the rest of those expirations.
exactly.
Because I mean, we just looked at the chart. And so we think, the market thinks that Tesla, might see those moves, whether it's to the upside or downside, but those big swings that we've been seeing.
Well,
And so,
that's something you want to think about when making these earnings plays is the life cycle of the company. So like Netflix used to be a more growth oriented company, but I guess since the streaming, markets are kind of saturated now, there's not like a lot of growth in that area. There's a lot of competition and stagnation. You're not seeing as much volatility, right? But Tesla, the electric car market, even though it's been around for a while, there's still like a huge global market that's untapped, right? So like a lot of your earnings plays are also going to depend on what the stock is. If it's a more growth oriented stock, you're going to see more volatility. You probably have more opportunities for premium strategies, but also more opportunities for loss because there's just more uncertainty with the growth stock.
yeah. But yeah, anytime you see more volatility, typically for options traders, that's more opportunity one way or the other. And so with the way the market is right now, the implied volatility ranks are still high
Yeah.
and stuff like that. And so I'm thinking for the out of the money call spread, we do something, we're not taking as big of a shot because we've already seen them make their run up, right? So how much more can it extend? Still out of the money. So what we're looking at here is like 28% probability of profit. It's better than something like 10. But when it comes to 28% probability of profit, that's not a super high, you know, high probability that you're seeing. But there's nothing wrong with taking a shot, right? When you're looking at the max loss to max profit here, let me make this five wide. We're paying $1.45 to see the profit potential of 355. And so, if that's a shot you're willing to take, there's nothing wrong with taking a low probability shot, especially, if that's, just what you see in the market. You think, hey, I think it's going to gap up. I want to get paid for taking that risk of it gapping up. And so we can look here at the 470, 465. Here, I want to take a look at the chart again, see if we see anything here from where it was. So, I mean, if we think it's going to go above its all-time highs or just market right there, around 470, that's a
Yeah.
trade we could place, right?
Yeah. What is the chances that it's going to hit, above 470, 480? It doesn't seem we could be on the safer side and go slightly above 470. I mean, it's the only problem is it's Tesla. This is the only thing is like Tesla, you just never know with Tesla.
You never know.
You never know
Yeah,
with
I mean,
Tesla.
Yeah, I see nothing wrong with placing a trade to, for it to get back to its all-time highs. I mean, we have
Yeah.
no clue what they're going to say,
Well,
just like everybody else. No one else has a clue what they're going to say either.
I think what's nice about
So,
this trade too is like the max profit on this trade is much higher than the max loss. And so I noticed this with low probability of profit trades is you a lot of times will have a higher max
yeah, you're
profit.
getting paid to take that risk.
And so it's like I feel like this is where you really gauge the risk and reward. Like, do I want to take honestly not that huge of a risk, only $145, but I can make double, two and a half, my
Yeah, where you're pretty much
outlay.
making like double what you're paying. And so that's fine for taking a shot that's, 30% probability of profit. So I say we send this in 145
Yeah, why
and see
not?
what
Yeah.
happens. All right, so we're working it there at 145, and then we'll penny this up. This is what we do all day, every day on the trade desk here. Just placing orders, and then there we go. There's our four trades, and so we could take a look. Let's just do a quick review, top to bottom.
Yeah.
So we've got Capital One. Here we've just got a short put spread, so something out of the money. We'll take a look at this on the trade page. Got out of the money, a little bit more aggressive, but if we see, it stay the same, the volatility come down, then we'll still make a profit, even though we're bullish. We think it's going to go up, but there's a little bit of a safer play than what we just saw. And then so we can also look at Netflix here as well. Now, Netflix, this is like our premium selling trade right here. It's the Iron Condor. I
Yeah.
mean, I wish we could do a strangle, but all we do is work on the trade desk. We're not there yet. We're,
Yeah,
we're
yeah,
still Johnnies.
yeah.
We're still Johnny one. We just work on the trade desk. And so this is our premium selling play here to do the Iron Condor. And then from here, we've got the Tesla trade. This is our shot. We're thinking it's going to go up for earnings. There's
Yeah.
nothing wrong with that. We think the trend's going to continue. I mean, it's tough to fade something like Tesla
Yeah.
and Elon. It's tough to fade something like that with what we've been seeing. It was really easy to fade at the beginning of the year.
Yeah, I mean,
Really easy to
we
fade then.
want to. It's not
But
that, oh, we don't necessarily want to, but everyone seems to want to fade Tesla at some
yeah,
point,
yeah. So not as easy to fade now. But so this is our just our shot. We're taking a shot in the dark here, seeing if it goes up for earnings. And then we've got TXN. This is also, our premium selling play here. It goes from 84% volatility all the way down to 56 and then should normalize eventually at around the 30s.
Yeah.
That's what we're seeing here. So this is our pure premium selling play. High probability of profit. I mean, when we're looking at it, this is what 80% probability of profit. That's pretty high.
That's a very
you know,
high for a
an
strangle.
earnings strangle.
Yeah.
That I mean, we're outside the one standard deviation, so that's what you'd expect, about 80%.
And
when
the
collecting
only
that
problem
premium.
with this trade really is the buying power effect is pretty high. $2,000 for $170 profit is not a great trade-off, but the beauty of it is that this is a 3-day trade. So,
Yeah,
that's
and it's if you're looking to sell premium, this could be something that you want to do. But there is a lot of risk. There's a reason it requires $2,000 to place this trade. But so yeah, this is what we'll see for a premium seller. That 160 profit, isn't great for $2,000.
Yeah.
But you have a lot higher probability than something like the Netflix. What's the probability on this Netflix trade when we're looking at it
I think
here?
that was in the 60s.
Yeah, I think it's like what, 65%, something like that. And then so, yeah, from here,
Yeah,
it's
65.
about 65%. And so you're getting, as a ratio of credit to buying power, you're going to receive a lot more. But it's because that probability of profit is lower. And then, yeah, that's what we see with those trades here. And that's what we've got for the different trades.
But you can really see the pros and cons of different strategies. Like the strangle, like the condor is kind of like the short condor is basically, right, a strangle that's just been defined risk. So you can see how with the other strangle we had earlier, it's like we have $2,000 we have to put up for $170 profit. Or with this condor, we're making the same amount of profit, but we're only giving up 350, which means you can have multiple other trades on. So a decision you have to kind of make occasionally is that 15% or more chance of me getting a profit on one trade worth it to not be able to place maybe 2 or 3 others? Because we could put on 3 or 4 more condors with that margin that we're using on the strangle. So
yeah, and I mean, that's really a great point because like you see with the earnings trades that they're a lot less flexible in nature. because they're that binary event. It either goes up or down, or the volatility expands or it crushes. And so maybe that's something where you want to stay defined risk, even though like the naked options give you more flexibility. Just in the nature of the earnings trade itself, there's not much flexibility. So maybe that's where you want to stay defined risk. Or if you do want that wider range, that higher probability of profit, you have larger accounts, more funds to trade with. Maybe you do want to stay on defined risk. So that's something that's up to you, but definitely super important to consider. And then from here, let's go back to the presentation and then talk about some additional risks here. Okay. And so some additional risks, Luke, if you could enlighten us on some of this.
So yeah, I'm always doing risk for some reason. Gotta love risk. This is why we're in options in the first place. So you always have assignment risk with options. So, you're short something, it goes against you. You wake up the next day, someone exercised the other side. Now you have 100 shares of something. You probably have a margin call unless you have a larger account and you can take the notional value. And then assignment risk is also notional risk, right? When you take on shares, a large amount of shares, $1 movement is a lot harder to deal with than if you just have the option that's out of the money. And then there's the lack of adjustment opportunity. So earnings plays are typically short term. The volatility doesn't ramp up until probably like a week before. I don't know the exact time scale of when the
And it
earnings
can
volatility
be
ramps up.
different for every company, right?
Yeah, and it's different for every company. Like we were talking about earlier, it depends on where the company's at. It's, the life cycle of companies, the life cycle of the business. This is going to affect sort of the timeline of when the earnings volatility will appear and how much time you have to make these plays. But regardless, you're not getting, 40, 50, 60 days usually. And then increased volatility, while it's good for options traders, volatility doesn't necessarily mean the market's going to go down. Volatility just means the market's going to go in some direction. So it could go down, it could go up, and that could mean you are left holding the bag. And then finally, price risk, general market risk, right? Options are a lot of times in these cases, you're speculating on something. And speculation means that most of the time, unless you have insider information or you're just a wizard somehow, no one knows what's going to happen. So, yeah.
Yeah, like something we specifically see with the earnings is if like it goes one way and then it could just stay there, and then your position might be out of luck. And so these are definitely risks that we want to touch on the assignment. If you ever get assigned and it causes a margin call, you can always just close out the position, and that typically satisfies the margin call. And then lack of adjustment opportunity. When you're trading earnings, it's that binary event. It's one day. You don't have much time to, roll down the untested side or, adjust the position however you want when managing it. You don't really have much opportunity because it moves. And then, that's the earnings play. And then increased volatility. That's one of the benefits of earnings, but that's also something to watch out for is, we're expecting a big movement because there's going to be announcements. So something to be aware of. And then price risk, that sort of just sums up all the above. The options moving, that gamma risk, that price risk, because you're getting paid to take these risks, especially when selling options. And so there is that price risk, but that's why you're getting paid. And that's why the opportunity arises. And then so here, let's go over some of our resources. We've got support.tastytrade.com. That's where our help center is. You can also find our contact information is there, which Christian can also link to as well. And then I think here we're going to wrap up the demo. And so if you have any questions, we'll stay around for another 10, 15 minutes if you would like for any Q&A. I see Christian and Andy have done a great job with answering some of the questions. And then just before we head out of here as well, there's some things I would like to touch on the platform for trading inspiration as well, is looking at the follow feed. This is something that you can do to see just for earnings plays. So for example, we see Fauzia doing an earnings play right here. This isn't, trade recommendations from us registered representatives, but this is something that we have available on the platform. So you could change the type filter to earnings only. And then here's all your earnings trades that you can look at. So we've got Netflix, a bunch of people doing Netflix here. We have some UAL from the other day. So as earnings season continues, if you need some trade inspiration, this is definitely something that you can look at. And then another thing we've got as well is the back testing feature. And so we have videos on here on how to use this. But if you saw there were previous earnings on a stock and you want to see how your position would have done, if you think maybe the same thing is going to happen, or you want to analyze your strategy, that's something you could do here as well. I think we've got over 200 companies here on the back testing software. And so that's something that can be super useful to use. And then we have demos and YouTube videos specifically just about the back testing. And we see a lot of customers using this to give them more conviction, more confidence when placing their trades.
Well said. Well said.
Yeah.
You got a million tools at your disposal. A lot of times the problem is just knowing which one to use, really.
Yeah. Yeah. And so the follow feed, just to go over that again, that's here on the left-hand side.
Let's see what's going on with these questions.
And then are there any demos on how to use the curve analysis? Yes, we've got a demo coming up on that soon, I think in November, if I remember correctly, November, December. But we do have specific demos and YouTube videos to do the curve analysis. We can actually view one of the, we could view like the Netflix position in the curve analysis mode. It would be under trade mode. And then on the right-hand side, you would want to hit analysis and then activate analysis mode. And then this will show you your given risks. And then we've got the at expiration line and then the Theo profit line, just showing that off quickly. And then we have example demos and webinars just based on this topic on this one page. And we've got more coming soon as well. And then how do we see how other traders are doing on the app? Christian, do we have the capability on the mobile app yet to see through the follow page? I'm not exactly sure. The mobile app has been improving immensely though recently. It used to be just just your trade desk in your hand, which is wonderful. But now we're starting to add a lot more ease of use features to the app as well. And so that's something we're looking to add. And then yes, it is on there. So you can tap more on the bottom bar, you can tap more and then it will show the follow feed there as well. So that's a super cool feature that we have it on the mobile app. The mobile app is making huge improvements.
I don't think we have the analysis tab yet, but I'm sure we will soon.
Oh yeah. Oh yeah. I mean, the mobile app's improving every single day. And so I love that. And then also one really cool thing about tastytrade is like we listen to the customers, the product managers and the developers. They listen to the customers. So whatever you want, send us an email to support@tastytrade.com or feedback
Yeah, I
at
think feedback at
tastytrade.com.
tastytrade. We have a direct email. So whatever you want or whatever you feel like is absolutely necessary, let us know.
Yeah, please let us know. I mean, we're always here to take the take the feedback from the customers. And then, yeah, just to show how to get to the analysis tab again, let's say you're on positions, for example, and you're just looking at your different positions that you have open. You can go to on the right-hand side, it would say where it says analysis on the bottom here. On the desktop, it's very similar. It's one of the icons on the right-hand side. And you click analysis. And then since we have analysis mode already activated, it will just come up automatically. But if you click this, it'll show activate analysis mode. And then from here, that's what will pull up the given analysis for the trade. All right. Well, if that's it, everyone, thank you so much for joining Luke and I on the tastytrade trading earnings demo.